Hello guys and welcome back. In this video I'll be talking to you about the CoT, which I have found to be a very great tool for tracking the big traders. Now the concept that my strategy is based upon hasn't changed. It hasn't changed a bit. It is still based upon following the big traders, and then the CoT is a very great tool for following the big traders because the CoT talks about the commitment of traders. This is where they are putting their money, right? The numbers here shows us where the big traders are putting their money. So in this video, I'll be showing you how that the numbers don't lie, even when the news can lie. And we'll be looking at the perfect example in crude oil. Now, this is the voice of David MANXA, formerly known as Complete Trader, but right now we've rebranded the name to reflect more about the person that is behind this. So my name is David MANXA, and I want to say a very big thank you to you guys for staying with me, and thank you for all of you who've subscribed before and you stayed with me all through the years, even though I've not posted a single content for about a year now. I want to say a very big thank you. Now, while I've been away, I've been working on different things, and this is part of the things that have kept me away for that long. I've been working on so many things. Like I said before, the concept didn't change. It's all about following the big traders, but I've devised better ways of following them, and part of that strategy has to do with the CoT. Now the CoT is institutional positioning. I'll talk about more on the CoT in a subsequent video, but it gives us a sample size of the big traders, right? It is a glimpse into what the big traders are doing, right? And this has to do with the big traders in the futures market and in the options market. Now, a big trader is a big trader, not minding where they are trading, whether it's in the spot market or in the futures or in the options market, okay? Because these guys have great tools available to them, and then they have connections all over the place, you know what I'm saying? So these guys are big traders, all right? And it is best to follow them, to follow where they are putting their money, as against following what people are saying on the media, okay? And I'll be giving you an example of that in this particular video. You know, the more you look into this, the more you agree with the saying that when it comes to forex, guys, the numbers don't lie. So this is WTI. This is how I track crude oil. Now I have these numbers. This is my all right, so this is my CoT spreadsheet. All of this is representing the numbers of contracts that traders, large traders within this market, have been putting up, you know, week in, week out. So we have this same spreadsheet for other currencies, US dollar, euro, and so on and so forth. But in this particular example, let's just focus on crude oil. So let me give you an example of a pattern. One of the patterns that I have discovered on the with the CoT that is very, very, very powerful. Now in my training course, where I've talked about the CoT and my new approach, okay, to trading and following the big traders, I talked about 3 patterns that the CoT gives, and this is just one of them, and it is so powerful, and you see that in a bit, okay? So one of the patterns is extreme, the extreme pattern. One of the patterns that CoT will give you is the extreme pattern. And what is that? This is when the big traders are at an extreme,
when they are overbought or oversold.
Now this is the real overbought and real oversold reading, where they have extended themselves too much, maybe on the longs or on the shorts, based on what the numbers are saying. All right, so how do I measure my overbought and oversold? I have my 26-week CoT index. All right, under this is calculating the net position, and we are looking at the current net position compared to what has happened in the past, okay, compared to what has happened over the last 26 weeks, okay. And then a reading of 100 is overbought, and a reading of 0, like we had here, is an oversold. Now when it is overbought, it suggests that they've been buying for a while, and then they might be looking to take profits of their longs, okay. And if it's oversold, it means that maybe they've been selling for a while, and then you have to expect them to start taking profit off of their sell. And if they are taking profit off of longs, what do you think the instrument will do? The price of the instrument will start to go down. If they are taking profit off of their shorts, okay, the price of the instrument should start to become lighter and begin to rise. Okay, so in this example, we're going to be focusing on what happened during the month of September going into October, where we saw an overbought reading for the oil market. You know, when this happened, all over the news, there were indications that price of crude oil should go up, and the reason was because Hamas at that time attacked Israel. Okay, and if you understand the character of oil, how oil behaves, whenever there is unrest or there is fear that, you know, the supply of oil is going to cut off, maybe due to war, due to some unrest and any other thing in the Middle East, because the Middle East is where you have a large amount of water supply for oil coming out from. Okay, so when that happened, that attack on Israel happened on, I think, on October 7th. We see that in the chart in a bit. So when that happened, there was this fear that the whole thing is going to escalate, and that the other Arab nations are going to join in all of that and attack Israel, right? But the bottom line is, people were expecting that the whole thing is going to escalate, and you know how it's going to affect oil. The price of oil should rally. That was the expectations. That was what the news was suggesting. But I'll show you what actually happened. Okay, because now we have two scenarios. We have two things contrasting each other. The numbers was suggesting at that time that the big institutions want to take profit of their longs. Okay, because they've been buying and now they've come to the position of overbought. But the news was suggesting something different, that based on the attack on Israel and all of that, that the price of oil should rally. Okay, now this is why I keep on saying that if you have the news set in contrast with the numbers, go with the numbers. Okay, because the news, the big traders are not putting their money on that. They're actually looking, this is where they are putting their money on. All right, these numbers don't lie, because it is actually showing us where they are putting their money, not where they are putting their mouth, but where they are putting their money into. Okay, so I will show you now in the chart. This is the chart right here. So during the time, okay, let's go back to this. You can see that the overbought reading came in during the month of September into November, into the first week of September into the first week of October. Okay, and this is what we have right here on the charts. Okay, so on the chart right here, this is US oil. What happened during that period of September? I'm going to pull up the daily chart right now, because the separators will show us what actually played out during the months. Okay, so this was the month of September. The oil was rallying, even though the CoT was actually predicting that we are most likely going to start seeing profit taking. Okay, now based on one of the concepts that I've been teaching on my channel, when the big traders want to sell, the best point for them to sell will be what? A buy side liquidity. That's it, guys, a buy side liquidity, because that zone is where they are most likely to establish most of their sell positions, because there are willing buyers around there, and a buy side liquidity has to be an old high. Okay, so there is this old high right here, which is actually a multi-month high. Okay, this is a multi-month high. Here you have, this is about a 10-month high, the highest point for the last 10 months. But then he also has this 1-2 months behind it, so which is to say that this was the highest point in about a year, right? So it's a multi-month high, and it's quite significant. So it's a good point for them to start to look for opportunities to distribute those longs that they've been holding all through this rally. Okay, and so when price came in, in line with what the CoT was suggesting, that they should be taking profit, we started seeing that from that point, price rejected, okay, and then began to sell off in spite of what the news was suggesting. Okay, so the news was still suggesting, because this was the time, this around here, we already started seeing the drop. Okay, so this was the day, this was around, okay, the attack took place during the weekend, and when Monday opened, when market opened on Monday, we had this gap in response to what the market was expecting. You see that? You see the gap, and then it gapped up and then traded up a little bit, but this trade up was intentional on the side of the big institutions, because this was market or price coming back to a point where the big institutions have to mitigate their losing positions right here. And this is gonna, this CoT can help you point out these areas very, very easily. But I've taught this in terms of patterns in this particular channel. So this is an example of the fact that the numbers don't lie. So whenever you're tracking the big trade, this is why I say I've devised better means of tracking them. Okay, and all of this is talked about in my course in greater detail. But when you have the numbers like this, in contrast with what the news are saying, those big media houses are saying, you want to always go with the numbers, because the numbers are revealing where the big institutions are putting their money. So we'll be talking about all of this later on, and even much more, because when it comes to directional bias, when I'm establishing my directional bias, there are 4 tools that I use. Number 1 is seasonality, number 2 is price, number 3 is CoT, which is this, which we've talked about here, and then number 4 is market flow analysis. Market flow analysis has to do with, you know, analyzing the intermarket relationship that exists between instruments. Okay, and then once we've established our directional bias, the next thing is to drop down to the lower time frame to look for trade setup and then entries. Straightforward process. All right, so we'll be talking about some of these things later on. I'll be giving you later on the overview of my strategy and all of that stuff. So thank you once again, guys. It is a very good feeling for me to come back to you, and I'm really, really glad. Okay, I'm really, really glad. Thank you.